Welcome to this next section, Disability Income Insurance. Individual disability income insurance underwriting, pricing, and claims. The purpose of underwriting and the principal functions and objectives of underwriting are to review applications to determine whether or not risks are acceptable, reduce adverse selection by eliminating risks that do not meet underwriting standards, and classify risks to establish appropriate rates and premiums for the degree of risk and benefits involved. Disability income policies will require medical, financial, and special underwriting considerations. Medical underwriting is the evaluation of the applicant's health status to determine whether to offer them coverage, at what price, and with what exclusions or limits. Financial underwriting is the evaluation of the financial aspects of the application. This is done to determine the correct amount of coverage for which an applicant qualifies, and particularly to avoid overinsurance. Overinsurance leads to an increase in the number and length of claims. An underwriter will evaluate earned income, unearned income, net worth, and bankruptcy history, if any. Special underwriting considerations: an applicant must be able to demonstrate stability of employment and income. Insurers will have employment requirements such as full-time, worked in the current occupation for a stated number of years, and if self-employed, to have been in business for a minimum number of years. An underwriter's job is critical. It is the underwriter's job to decide which applications to accept or to refuse. The tendency of poorer risks to seek and maintain insurance to a greater extent than better risks is called adverse selection. When an underwriter receives an application and the risk falls out of the normal range, the underwriter has the option to charge a higher premium or place restrictions or exclusions on the policy to make the risk fall within the normal range. If that does not work, the underwriter will decline the application. Classification means grouping applicants together based on similar characteristics and exposures. Risks which are acceptable to an underwriter are classified for rating purposes into one of three main classifications. The first is the preferred risk, that is those that reflect a below average risk of loss. These risks may be insured at preferred or discounted premium rates due to favorable risk factors such as healthy lifestyle, favorable medical history, low risk occupation. In life insurance, this group would have an above average life expectancy. In health and disability, they would have a lower incidence of illness or injury. Then the standard risk are those who reflect average exposures and fall into the normal range. And then substandard risks are those which reflect an above average or higher risk of loss due to health habits or occupation. These type of risks are still acceptable. However, the underwriter must use some rating technique in order to collect a higher premium or limit or restrict coverage so that these losses fall within the range of predicted losses. Let's look at the underwriting responses to the risk. Instead of issuing an exclusion, an underwriter may modify a policy by increasing the premium, increasing the elimination or waiting period, or decrease the benefit period, or use a more restrictive definition of disability, such as any occupation instead of own occupation. We'll discuss those two restrictions later on. Let's talk about the process of underwriting. It's important to understand the difference between the underwriting of life insurance and underwriting of disability insurance, as they're different products with separate sets of risks that are unique unto themselves. It's the agent's responsibility to prepare the application for the underwriting process. Properly setting expectations with your client greatly increases the likelihood of placing a disability income policy. The applicant needs to be informed that disability insurance underwriting is a lengthy process. Documentation of his or her income is crucial, and many medical conditions, while not life-threatening, may be disabling, such as a bad back. All these facts may result in a policy that's different than the one the applicant applied for, and it may be rated and or contain exclusions for pre-existing conditions. The field underwriting prior to the application is the responsibility of the agent. Agents have the duty and responsibility to solicit good business. This means that the type of business that falls within the insurance company's underwriting guidelines, resulting in being profitable. The agent must complete the application accurately and truthfully to the best of their ability. An application asks the applicant for information needed to issue an insurance contract and is the basis upon which a policy is issued. Delays and possible restrictions of commission can be avoided by the agent paying attention to detail when completing the application. Amendments are required when the application is changed, or there are unanswered questions on the application, or it's not properly signed, or the application contains inaccuracies. The agent's report, or the agent's statement, must be completed with each disability income application. The statement is essential to the underwriting process as it provides valuable information about the applicant, allows the home office underwriter to accurately classify him or her as a risk, and allows the writing agent to certify that they have disclosed all relevant information. The information supplied will assist the underwriter in processing the application in a quick and efficient manner. You have to know that insurance companies must not make unfair distinction between individuals in underwriting for the risk of human immunodeficiency virus, HIV, and acquired immune deficiency syndrome, AIDS. Underwriting for the risk of AIDS is tightly controlled. With the increasing number of people getting the HIV virus and contracting AIDS, the insurance industry has to pay close attention to applicants for life insurance and disability insurance. An insurance company must first get written consent from an applicant to test for HIV/AIDS. If an insured has coverage and dies due to AIDS or ARC, AIDS-related complex, the insurance company cannot limit or deny the coverage. The test performed for HIV/AIDS must be done and paid for by the insurance company, not the insured. The insurance company must supply the client with information regarding HIV/AIDS from a third-party source, and the insurer may decline a potential insured for coverage if his or her medical sample shows positive for AIDS/HIV after 2 different tests have been performed. Insurers are to avoid unfair discrimination between individuals of the same class in underwriting life and disability income insurance for the risk of AIDS and AIDS-related conditions. Insurance companies are to establish mandatory and uniform minimum standards for assessing AIDS and ARC. They're required to maintain strict confidentiality of personal information obtained through the testing. The insurance company can test all applicants and pay for the testing. Insurers must provide printed material describing AIDS, its causes, symptoms, how it spread, and how the test will be used, as well as suggesting counseling resources. Types of HIV tests include the ELISA test, ELISA, and the reactive Western blot test. Insurers can decline based on positive results. An insurer shall notify an applicant of a positive test results by notifying the applicant's designated physician. Sexual orientation may not be used in the insurer's underwriting criteria, nor may an insurer try to establish sexual orientation by asking questions about marital status, living arrangements, or beneficiary designation for the sole purpose of determining whether to test for HIV. Insurers who knowingly violate this shall be penalized with a $1,000 to $5,000 civil penalty. Know that insurers may not unfairly discriminate on the basis of tests of a person's genetic characteristics. Insurers are required to obtain informed consent before underwriting on the basis of genetic characteristics. Genetic characteristics means any scientifically or medically identifiable gene or chromosome or alteration thereof, which is known to cause a disease or disorder, or that is determined to be associated with a statistically increased risk of development of a disease or disorder, and is presently not associated with any symptoms of any disease or disorder. In other words, the insured is not sick right now, but their chromosomes indicate They may be sick in the future. Insurers are required to maintain strict confidentiality of personal information obtained through a test of a person's genetic characteristics. Any insurer that requests an applicant to take a genetic characteristic test shall obtain the applicant's written informed consent for the test. Let's talk about completing the application. The applicant must complete the application accurately and truthfully, and the agent has to do so within the best of his ability. The agent fills out the application. The customer signs the application. There are some additional information that may be required. In addition to the following, disability underwriters are concerned about prior criminal activity as well as foreign travel. Normally, these individuals with a felony history within the last 5 years will be declined. Extended travel to some non-English speaking countries, and countries that are politically unstable are definitely a concern for disability insurance. Disability insurance will not be considered for anyone traveling to a country on the United States State Department travel waiting list. Some other areas that underwriters use are the MIB report, formerly known as the Medical Information Bureau. This alerts underwriters to any medical impairment or risk factors significant to writing disability income insurance that has been gathered by other underwriters. The Disability Income Records System at the MIB gathers underwriting information from other companies where the applicant may have applied, and the purpose here is to avoid potential overinsurance. The underwriter may ask for the client's attending physician's statement. This is a copy of the individual applicant's own medical records from their own doctor. Underwriters may also get a credit or inspection report. We can check the personal interview inspection report, where investigators actually check out the individual in their local community, or check their motor vehicle record for MVR driving history. So the MVR can be checked, and they're specifically looking for a DUI within 2 years and other major moving violations. And then there are hazardous activity questionnaires. Do you scuba dive? Do you rock climb? Do you race motorcycles? You have to answer the hazardous activity questions, and if yes, fill out a detailed questionnaire. And then additional medical testing may be required, such as electrocardiograms, treadmill exams, etc., usually done and completed by a medical doctor. Let's talk about underwriting outcomes. The job of an underwriter is to protect the insurance company from acquiring non-profitable business. It is the job of the underwriter to protect the company and at the same time to give the agents an equitable policy with which they can sell. By assessing the risk carefully, an underwriter will be able to classify the risk into the appropriate class to determine the rate that should be charged. If both the agent and home office underwriter has done a good job underwriting the risk, the rate should be accurate. If both the agent and underwriter fall down on the job, the rate can be unfair and the loss is too high. Let's talk about the individual following the factors used in rate-making components. Rate-making is the process to determine pricing. Rate is the cost of a given unit of insurance. Rates are usually expressed per $100 of face amount of insurance in disability insurance. Premium is the amount paid by the insured, and it's the rate multiplied by the number of units of insurance purchased. A policy fee is usually included in the final premium. The average cost for a disability income insurance policy is between 1 to 3% of the insured's annual income. For example, an applicant earning $50,000 per year can expect to pay between $500 to $1,500 per year, depending on their occupation, age, and level of benefits. The following factors not only have an effect on how intense the underwriting process is, but then they can affect the rate. So the underwriter looks at morbidity, interest, and expenses. Morbidity, these tables show the mathematical probability of becoming disabled each year due to illness or injury at various ages. Morbidity statistics also review the average duration of disability. Factors that have an influence on morbidity are age, gender, health, occupation, avocations, and personal habits. Then insurance company expenses are taken into account. The expense factors are expenses that the insurance company will incur in issuing a contract. Included in the expense factors are the premium taxes, costs of licenses and fees, policy acquisition, administration, operations, overhead costs, record keeping, and statistical analysis. And then we have investment returns. The insurance company takes the interest earned off the insured's premium that was invested. This interest helps lower the premium for the insured. When calculating the insurance premium, the insurance company assumes a low rate of return, such as 2 or 3%. And then the benefit period, or the duration period. The benefit period is the maximum length of time that benefits will be paid during the period of disability. The benefit periods can range in weeks for short-term disability policies or 2 or more years for long-term disability. The most common long-term disability benefits are 2, 5, and up to age 65. Note that the shorter the period of duration, the lower the premium. The longer the benefit period, the higher the premium. Let's now talk about probationary period. When a disability income policy goes into effect, normally only accidents are covered right away. There is a probationary period, a one-time wait, which is usually 15 to 30 days before the sickness would also be covered. This is to reduce the exposure of someone who knows they are sick and hiding it until the disability policy is issued. Then there's an elimination period in every policy. The elimination period works like a deductible. It's the number of days after onset of the disability policy before benefits will be payable. Onset of the actual disability once you are unable to work. Therefore, it's said to be a deductible in time. During the elimination period, no benefits are payable. Common elimination periods for long-term disability policies are 30 days, 60, 90, or 180 days. All disability income policies contain elimination periods ranging from 1 week to a year or longer. Policies can contain a different elimination period for sickness versus accidents. Just note that the longer the elimination period, the longer you have to wait before you collect benefits, the lower the premium. The shorter the elimination period, the higher the premium. Let's now talk about the need for disability income. Disability income insurance provides a weekly or monthly income to those who are disabled due to sickness or injury as defined in the policy. These types of contracts are also called loss of time or loss of income policies. These types of policies are sold as individual and as group policies. However, there are many other sources of disability income. In addition to insurance contracts, there are state and federal plans, association plans, life insurance riders that provide a disability income, and even pension plans have a disability benefit. All of us face 3 basic risks: dying too soon, living too long, or becoming disabled. Death is certain. That's why people buy life insurance. Old age is a probability, which people must plan for so they don't outlive their financial assets. Then there's the risk of disability, often overlooked, which is why it's referred to as the forgotten need. Unlike death and retirement, becoming disabled is only a possibility. However, it's a devastating possibility because it affects a person's ability to earn a living. Once the flow of earned income stops, retirement and financial planning fall apart. The probability of becoming disabled during your working years is far greater than that of dying. This type of policy does not, unlike death and retirement, becoming disabled is only a possibility. However, it's a devastating possibility because it affects a person's ability to earn a living. Once the flow of earned income stops, retirement and financial planning fall apart. The probability of becoming disabled during your working years is far greater than that of dying. This type of policy does not pay medical bills or hospital bills. It simply replaces the loss of earned income due to illness or injury. It is said that disability eliminates any income and increases expenses. A disability insurance policy protects against one of the greatest threats to an individual's income, becoming unable to work due to the injury or disability. If you're physically unable to work, your income has been cut significantly while your expenses remain the same. Short-term disability insurance replaces your income for a short period of time, usually 3 to 6 months. Long-term disability has the same purpose as short-term disability, except it has a waiting period called an elimination period, usually 90 days, but it can be as long as 6 to 12 months. Then after the elimination period, the coverage can last for years. The average long-term disability claim lasts for about 35 months. Disability income policies pay benefits for illness or injuries as defined in the policy. Accidental bodily injury means the result of an injury of an unintended and unforeseen accident. This is the most common definition used for disability income policies. A sickness or illness which first manifests itself after the effective date of the policy or after the policy has been enforced for a specified number of days, such as 30 days. This is called the probationary period. The benefit amount paid is usually the same whether the disability was due to an accident or to an injury. Just like life insurance, disability insurance is protection for your future income. In the case of disability insurance, though, the event covered is your inability to earn a living wage as a result of poor health or injury. What's the likelihood of disability? One of the biggest myths about disability is it does not happen to younger people. The following chart shows the odds of having a long-term disability, one lasting more than 90 days, before age 65, along with the average duration of that disability. So it turns out younger people have a much higher chance of being disabled than older people. For example, in the chart, a person age 30 has a 1 in 3 or 33% chance of becoming disabled before age 65, and the average duration of a disability at that age is 32 months. A 40-year-old has a 3 in 10 chance, 30%, and the average duration is 42 months. A 50-year-old has a 5 in 22 chance, and their duration is 50 months. And a 60-year-old or over, it's a 1 in 10 chance, 10%, and the duration is longer at 54 months. So study that chart in your text. Let's now talk about partial and total disability. For the purposes of determining the exact circumstances under which an insured may be entitled to benefits under a disability income policy, you need to understand what's considered to be total disability. Total disability must be defined in the policy because it determines if the disabled person is entitled to benefits. Total disability means the inability to work based on the definition used in the policy. The two most common definitions are own occupation, the inability to perform the duties of one's own regular occupation. Under this definition, you're considered to be totally disabled if you're unable to perform the important duties of your own regular occupation, even if you're able to do some other kind of work. Many policies now offer this definition for the first 2 years of disability and then change to any occupation based on the education, training, or experience. Own occupation classification is considered to be a liberal definition. An own occupation clause in the disability income policy would allow an emergency medical technician, for example, who no longer can perform her duties on that occupation due to an illness or injury, but could return to gainful employment as a telephone solicitor and continue to collect their disability income under their policy. Policies using this definition are normally marketed to professionals and higher income markets. The any occupation definition is the inability to perform duties of any occupation based on your education, training, and experience. This is a more restrictive definition. If the medical technician's policy used this definition, once he or she returned to work as a telemarketer, the benefits would cease from their disability income policy. Policies using this definition are usually marketed to the middle income earners. Most disabilities that happen are partial. Benefit payments from policies that cover partial disability as a result of the injury or sickness are based on either the inability to be able to perform one or more, but not all of the material and substantial duties of your own or any other occupation on a full-time or part-time basis, or the ability to perform all the material and substantial duties of your own or any other occupation, but only part-time. So you can't do all of your job, but you can do some of your job. That's partial disability. Or you can do all of your job, but you can't do it for 8 hours a day. You can only do it part-time. The benefits payable under a partial disability benefit is usually based upon a percentage of the total disability benefit. The benefit for partial disability is usually 50% of the policy benefit for the first 3 to 6 months. Let's now talk about Social Security disability income, which is a federal program. If you recall from the previous section, this has the most restrictive definition of disability. It should be noted that qualifications for Social Security disability benefits is subject to rigid requirements. The qualifications are: you must be properly insured status, meaning you're both fully and disability insured. You've had earned income for the required number of quarters to be qualified. You meet the definition of total disability, and you've satisfied the waiting period. The definition used by Social Security is total and permanent disability based on inability to engage in any gainful activity or employment, and the condition is expected to last at least 12 months or result in early death. And note that there is no benefit for partial disability under Social Security. So you have to be basically paraplegic, totally disabled, can't work at anything, and the disability will continue for at least 12 months. So you're really seriously injured or seriously ill. Individual and group disability income policies are written in either occupational or non-occupational status. Occupational policies means policies provide disability benefits if the disability was a result of any injury or illness that happened either on the job or off the job. Usually these policies cost more because of the higher risk in paying claims on and off the job. When a policy is written occupational, it means you're covered 24 hours a day. A non-occupational policy provides disability benefits if the disability occurred off the job and is not related to work. That's the kind most people buy because most folks are covered at work for partial and permanent disability by workers' compensation policies. Let's talk about insurer limitations on coverage amounts. Limits are placed on the amount of disability income that can be purchased to prevent overinsurance. Overinsurance would create a moral hazard. This means that if a person could earn as much or more than they did while working, they might become disabled on purpose or to be reluctant to return to work. Insurers only issue a percentage of your income to prevent malingering or moral hazards. Individual policies are normally limited to about 60% of earned income. Group policies provide a higher percentage because the benefit is taxable. Let's now talk about limitations placed on the benefits. If the proposed insured has a hazardous job, since there's a higher risk of claims, there could be a limit placed on the policy. Those who do manual labor would be issued a lower benefit than those who do mental labor. Once again, the person doing manual labor is more likely to suffer a claim and take longer to be able to return to doing their physical type work. There's some definitions you should know. Permanent disability is one that reduces or eliminates the insured's ability to work for the rest of his or her life. Temporary disability occurs when an insured is unable to work while recovering from an illness or injury, but is expected to fully recover from the illness or injury. There's 4 levels that classify the insured's disability. Permanent and total would be total disability from which the insured does not recover. Permanent partial is a condition where the insured's party earning capacity is impaired for life, but he or she is able to work at reduced efficiency. So you could hold some income producing job. Temporary total is a condition where the insured party is unable to work at all, while he or she is recovering from injury, but is expected to fully recover. And temporary partial disability is a condition where an injured party's capacity is impaired for a time, but he or she is able to continue working at reduced efficiency and is expected to fully recover. Let's now take a look at the uses of disability income. Just like in life insurance, health insurance products can have personal uses and business uses. Personal use of disability income is simply replacing the loss of income to family due to an illness or injury that can prove catastrophic without the disability income insurance policy. Though there are government programs such as SDI and Social Security, they're limited either by being short-term, like SDI, or very difficult to qualify for, like Social Security. Many employees are willing to take less in wages in exchange for better employee benefits. An employee benefit package benefits the employer in the following ways. It contributes to employee morale and productivity. Employer can provide needed benefits that employee would have to purchase with after-tax dollars. It helps recruit and retain employees. The employer declares the premium paid as a business expense, and it enhances the employer's image. Let's talk about the two different kinds of policies, the individual and the business overhead. Individual disability insurance is designed to replace normally 40 to 60% of the employee's gross earned income, not any passive income, on a tax-free basis should a sickness or illness prevent you from working. When you think about it, most people give up about 30% of their pay for withholding taxes, Social Security, Medicare, take home about 70%, and these policies allow you to replace 40 to 60%. So if you buy a 60% policy, very close to your same take-home pay. A business overhead expense policy, this insurance is designed to reimburse a business for overhead expenses in the event a business owner becomes disabled. This is not the same as personal disability insurance, which usually pays benefits to age 65. A business overhead expense policy pays a shorter benefit of 1 or 2 years and reimburses the business owner for ongoing business expenses while they're disabled. These expenses include mortgage payments or rent, electricity, telephone, heat, water, laundry, and other fixed costs normal to the operation of the business. The premiums for business overhead expense policy is tax deductible by the business that pays them. However, the benefit they receive is taxable. So that's a general rule of thumb in life and disability insurance. If you write off the premium as a tax deduction, then the benefits are taxable. If you pay the premium with after-tax dollars and don't write it off as a deduction, then the benefits are tax-free. Let's now talk about a business disability buyout policy. The use of disability income insurance in funding business continuation arrangements is the second most common form of business disability income insurance. The policy provides cash funds to a business or professional partnership or small corporation to purchase the business interests of a totally disabled partner or stockholder. The premiums are not tax deductible, therefore the benefits are not taxable. How about a group disability policy? Many disability income policies are sold as part of employee group benefit packages that typically include group life and group health. Coverage can be placed on all of the firm's employees, including partners, self-employed, and employees who are stockholders, as well as the larger pool of hourly and salaried employees. Group disability income policies are generally more liberal than individual plans in terms of having fewer limitations and exclusions and greater ease in acquiring coverage. As a general rule, group plans are less costly to all concerned than individual plans. The premium paid by the employer is tax deductible as a business expense, and any benefit received by the employee that was paid by the employer is taxable. Let's talk about key employee and partner policies. Key man disability insurance is purchased on one or more key employees in a business to protect the business from the economic loss associated with the disability of a key employee. The company buys the insurance and is also the beneficiary of any proceeds should a disability arise on that key person. Let's now talk about eligibility and rating factors. The following factors are used to establish eligibility during the underwriting process, as well as rating factors to determine the final premium. These are in addition to the three primary factors: morbidity, interest, and expenses, benefit duration, elimination period, and definition of disability used in the policy. So the first, of course, is age. The applicant's age is very important in rating disability insurance. As people get older, the chance of death, accidents, or illness increases, and therefore higher premiums are set to compensate for the anticipated claims. There are also minimum and maximum ages for qualifying for disability insurance products. Gender: statistically, females are a higher risk than males. Females have a higher frequency of claims. Women are more likely to suffer from autoimmune disorders, depression, and more likely to seek help for these conditions. Also, women are more likely to have a second household income and can afford to stop working to address their condition. How about job classification or occupation? Perhaps more so than with any other insurance product, occupation is a critical factor in underwriting the disability income risk. What the client does for a living will largely determine what kind of contract he or she can buy, the maximum benefits, and how much the premium will be over the years. As a result of collecting many decades worth of disability claims, insurance companies now know which occupations are the most hazardous. Not only that, they know which occupations trigger the longest disability. Occupations are categorized into 4 to 6 classes or groupings based on the risk of disability associated with each occupation. This basically means higher rates are charged for higher risk occupations and lower rates for lower risk occupations. Occupation is the most important rating factor in underwriting and determining premiums for a disability income policy due to the degree of risk. At the top of the scale are professionals, which are low risk, such as doctors, attorneys, CPAs. The other professionals and employers which primarily have office duties, followed by white collar and selected blue collar workers like supervisors, then skilled clerical and technical workers. Next come semi-skilled and unskilled blue collar employees, manual workers, barbers, unskilled clerical and sales clerks, and last are the least insurable group, such as carpenters, bricklayers, baggage handlers, and iron workers. There are some occupations that are not insurable for disability income policies at all, such as air traffic controllers. Why for them? High stress job. Let's now talk about avocations. Avocation is a hobby or interest. If a hobby is dangerous, like skydiving or rock climbing or scuba diving, then the insured will pay higher premiums, or the insurance company will exclude it with an exclusion rider. If the insured's hobby is safe, like coin collector, the premium will not be affected. And then health. Eligibility and rating factors depend partly on the insured's past and present health conditions. If the applicant is healthy and has a good medical history, then he or she will have low premiums. If the applicant is sick or has a number of chronic health-related problems or a bad family history of health problems, the premium will be higher or the application can be denied. Let's take a look at the effect of taxes on participants and sponsors. As mentioned before, taxation of disability income benefits depends on who pays for the policy. If they're paid by the insured, the premiums are not tax deductible, and the benefits are received tax-free by the recipient. If the group disability income policy is non-contributory, meaning the employer pays the entire premium, the employer was able to deduct the premium as a business expense, therefore the benefit received would be taxable. If the group plan is contributory, employer and employee share the premium, then a portion of the benefit would be taxable. When an individual buys personal insurance, the premiums paid are not tax deductible. Since the individual did not take a tax deduction, the benefits received would not be taxable. They're tax-free. This is another reason that insurers place limits on the amount an individual can purchase. If the insurer allowed someone to insure 100% of the gross income, they would be receiving a disability benefit higher than if they were working than before taxes were deducted. Let's now talk about provisions and riders. There's maximum and minimum benefits. The range for maximum and minimum benefits paid in disability insurance is somewhere around $500 to $10,000 a month, depending on gross earned income. Benefits will usually not exceed the 50 to 70% of monthly gross earned income. The insurer will also consider other sources of income to prevent overinsurance. Such sources may include group or individually owned policies and even state or federal income benefits. Notice of claim. This is a mandatory policy provision describing the policyholder's responsibility to the company in reporting a loss. After the occurrence, the insured must file a notice to the company within 20 days or as soon as reasonably possible. In the case of disability, the insured must submit proof of disability before the company will send payments. Let's talk about the automatic increase provision. Some individual disability policies offer a rider that automatically increases monthly benefits for a specified period of time, like for 5 years. A typical increase is 4% compounded. Good disability insurance plans provide automatic increases despite any changes in health, income, or occupation. Let's talk about a big area of definition, the own occupation versus any occupation. Benefits are paid to the insured if he or she is unable to perform daily activities related to his own occupation. If the policy uses any occupation in the definition, benefits are paid to the insured if he or she is unable to perform duties of any occupation based upon their education, training, or experience. The any occupation definition is a more restrictive definition than own occupation. Let's talk about the cost of living rider. Suppose you're receiving a $6,000 monthly benefit. At 6% inflation, the benefit will only be worth $1,872 at the end of 20 years. Therefore, one of the most important aspects of your disability income plan would be the protection it affords against inflation. Individual disability insurance policies generally offer a cost of living rider, COLA, that will adjust benefits for inflation during a long-term claim. Short-term disability policies have benefit terms of less than 2 years. Many are written with benefit periods of 6 months to 1 year and are usually expressed in weeks. The elimination period is also shorter for short-term policies. Long-term disability policies have benefit periods that are greater than 2 years. The elimination periods are longer, 30 days, 60 days, 90, or 180 days. Let's now talk about a rider called the Social Insurance Substitute Rider. Social Insurance Supplemental Benefit Riders was designed to fill gaps left by various government benefit programs. The concept is similar to the Social Security Benefit Rider, except this rider provides coverage that can also be coordinated and combined with workers' comp benefits and state disability benefits. Benefits would be paid during any waiting period for social insurance benefits or if the social insurance benefits are denied. Benefits will be paid monthly until the government benefits begin. So this is a way to get you coverage before your government disability programs or your workers' comp disability kicks in. Let's talk about benefit integration. This provision prevents benefits from being duplicated and protects against overinsurance. To do this, the insurance company will reduce its benefits by an amount equal to the insured's other disability payments. Again, this helps prevent overinsurance. It's called benefit integration. Another concept to know is residual disability. What happens if an insured is only partially disabled? Partial disability can come in several forms. Perhaps he or she can perform some, but not all of the major duties of the job, or can work only part-time. Under the definition of total disability, no benefits would be paid. To solve the partial disability problem, the residual disability concept was developed. Under a residual disability provision, either in the policy or available as a rider, an insured receives a percentage of his or her disability benefit based on the percentage of income loss the sickness or injury has caused. For example, let's suppose Dr. Jones was earning $10,000 per month prior to his disability, and when he returned to practice, he was earning $4,000 a month, a 60% drop in income. Also suppose Dr. Jones had a disability insurance policy that paid a full disability benefit of $5,000 per month. If his policy contained a provision for residual disability, he would receive 60% of his $5,000 benefit, or $3,000 per month. How about a rehabilitation benefit? To help a disabled insured return to work in his or her own occupation, or even any other occupation, most disability insurance policies offer a rehabilitation benefit. This benefit pays some of the expenses when the insured enrolls in an appropriate approved rehabilitation program. How about a recurring or recurrent disability? Under better disability insurance policies, the elimination period permits brief periods of recovery without having to start over from the beginning. Recurrent disability is a second period of disability for the same or related cause as the prior disability. Most disability income policies stipulate that if the insured returns to work after the original disability and is disabled again for the same condition within 180 days, the recurrence or relapse is treated as a continuation of the prior claim. How about transplant benefits? Under a transplant and cosmetic surgery benefit, any disability arising from donating or transplanting an organ in a life-threatening situation is deemed to be covered as a sickness and benefits would be paid under the policy. How about beneficiary? Since some disability income policies offer accidental death and dismemberment benefits, a beneficiary is required. The death benefit would be referred to as the principal sum. For the policy to pay this benefit, death must occur within a specific number of days of the accident, usually 90 days, with the accident being the direct cause of death. Every company excludes certain causes of disability from disability insurance coverage. These exclusions are stated in the policy. A universal exclusion is the pre-existing condition, an ailment that manifests itself before the policy was purchased but was not disclosed on the application. Other common exclusions for disability policies are acts of war, commissions of a crime, suspensions of a professional license, normal pregnancy, attempted suicide whether sane or insane, alcohol and drug addiction, aviation, military and war actions, and some policies limit benefits, typically to 24 months, for mental or nervous or substance abuse disorders. If the loss occurs while the insured is traveling on foreign soil, benefits may also be limited or denied. Let's talk about the renewability provision. Each policy must contain a renewable provision that allows the insurer to continue or discontinue coverage. The renewal provision used affects both the premium and the underwriting considerations. The renewability provision, also called the recall provision, are non-cancelable, guaranteed renewable, conditionally renewable, optionally renewable, and cancelable. These provisions were discussed under the general concepts in a previous section. Let's talk in more detail about the pre-existing conditions. Most employer-provided long-term disability policies and some individual disability income policies include an exclusion for disabilities caused by a pre-existing condition. Generally, a disability insurance pre-existing condition is defined as a mental or physical condition for which you became disabled within the first 12 months of coverage and that existed for which you received treatment within the 3 to 12-month period just prior to the date of coverage under the policy. An admitted pre-existing condition, sickness, or injury shows up on the application and is not specifically excluded will be covered from the date of the issue of the policy. However, failure to inform the insurer of such pre-existing condition could result in denial of a claim and/or rescission of the contract. So it's always best to disclose the pre-existing condition, and many times there will be no exclusion of that condition. Let's talk about lump sum benefits. Though the mandatory provisions state the income cannot be paid less frequently than monthly, there are two situations where disability income is paid in a lump sum. Some individual disability insurance policies pay a lump sum benefit for certain specified losses, such as the loss of the sight of one eye with no possibility of recovery, or loss of a hand or a foot severed through or above the wrist or ankle. This benefit, 12 times the monthly benefit, is paid in addition to any other benefit you might qualify for under the policy. So that's called a capital sum benefit. Then there's a waiver of premium rider. A waiver of premium provision relieves you of having to make premium payments after you've been disabled for at least 90 days, or the length of the elimination period if shorter. In effect, it frees up money for other expenses when disability has caused a drop in income. How about the Social Security benefit rider? With this type of rider, the insurance company offers an additional monthly benefit to the approximate amount that Social Security would pay. This rider provides additional payment equal to the Social Security benefit until the Social Security benefit begins to pay. Since the Social Security definition is very restrictive, if the insured cannot meet the definition, they can continue to receive this additional amount from their own policy. Should Social Security benefits be approved, the insurance company will stop paying this additional amount. Then there's the guaranteed insurability rider. This option allows the insured to purchase additional amounts of disability income coverage at specific intervals without proving insurability. And then the hospital confinement rider. This rider waives the elimination period should the insured be hospitalized on an inpatient basis. This means benefits would begin on the first day of hospitalization, even though the elimination period was not satisfied. How about a non-disabling injury? This provision or rider pertains to an injury that does not result in total disability. Instead, the provision allows the insurer to pay the medical expenses for the actual cost of medical treatment for the injury that resulted from an accident. And then the workers' comp 24-hour coverage. The California Insurance Code defines 24-hour coverage as a combination of workers' comp insurance with a group disability insurance policy, a healthcare service plan contract, or other medical insurance coverage for non-occupational injuries and illness. Life insurance is not included in the 24-hour coverage. If an insured is hurt, the time and place do not matter. The employer is literally covering 24 hours a day, 7 days a week in this combination policy. That concludes this section. It's now time to take your test tips.